Okay, so welcome to financial reporting. Um, so this is just the very first topic in the syllabus, the regulatory framework. So hopefully we'll be able to finish it in this class. It's not that much. Okay, so regulatory framework. When you hear the word regulatory framework, I think what should come to your mind should be when you hear anything regulatory, it means law. Then framework is just like the guidelines. So regulatory framework is basically talking about the guidelines that we use in the preparation of accounts and of our financial reporting. Guidelines that is used in financial reporting. So let's see what we have here. So the objective of financial statements is to provide information about the financial position, performance, and cash flow of an entity that is useful to a wide range of users in managing economic decisions. There are several reasons why financial reporting should be regulated, and the most obvious one is that without it, an entity are free to adopt any accounting treatment it chooses. Other reasons, we have people external to the businesses and normally dependent on the published financial statement for information about the entity activities. Regulation ensures that external users of financial statements are provided with information that is relevant and reliable for decision making. So, the major reason why there is regulation in financial reporting is to ensure that, you know, company ABC are not just doing what they like, they are not adopting the treatment that they choose to adopt. Why another reason is that because of the people that use the financial statement that have been published by this entity, um they are dependent on it to make any decisions that they want to make. So it has to be regulated, else they might be giving them information that is not relevant and information that is not reliable. So another reason is that accounting standard and other form of regulation help to ensure that entity adopts similar accounting treatment for similar items and account of similar transaction in the same way. So we want to ensure that the way revenue is treated this year is the same way revenue is treated next year. We want to ensure that the way cost is maybe any admin cost, any depreciation, the way you are following straight line this period, follow straight line next year. The way you are treating your assets, if you are carrying them at cost, make sure you carry them at cost next year. Don't use cost this year and go and use the other method next year. So you need to be consistent. So that's another reason for financial regulation or this regulatory framework. Then another reason for regulation is that management would adopt whichever accounting treatment that presents the best possible light. So if there are no regulations, maybe I use um cost method last year for recognizing my fixed asset or my non-current asset. This year now, because I now saw that it's like the way I did this thing, I don't like it, or it's not giving me the best results, I'll now switch to revaluation model because I just want my financial statement to look good. You get. So there will be window dressing, there will be creative accounting if there is no regulatory framework. So it's important that we have regulatory framework to help us, in preparation of our financial statements. Then what are the sources of this regulation we are talking about? We have the accounting standard, we have company law, we have sectoral regulations, that is regulations that are related to the industry your company is existing. Then the listing rules of the relevant stock exchange for listed companies. So for accounting standard are authoritative statements of how particular type of transaction and events are reflected in the financial statement. They are usually issued by IASB. So we have the IFRS that is currently used in Nigeria, and that's what concerns us. We don't need to look at other regulations like that is not in Nigeria. except if you're in that type of industry and there's any other international regulation that guides you. So, but for the common one that has been adopted by over 180 countries, including Nigeria, is IFRS. And that's what guides the preparation of the financial statements. So we have the accounting standard, we have company law. Company law will vary from country to country, right? What is applicable in Nigeria might not be applicable in the US. What is applicable in the US might not be applicable in the UK. But for Nigeria, because this is ICAN, but for Nigeria, what concerns us is the Companies and the Allied Matter Act 2020 as amended. So this also guides us in, in the issuing of share capital, redemption of share capital, how to share your profits when you make one. Then we have sectoral regulation. This one relates to certain industry. If you are in the insurance industry, you're expected to abide by some rules. If you're in the banking sector, you'll be hearing something like prudential rules. If you're in insurance, you have your own set of rules that guide you. If you're in the investment industry, you have your set of rules that guide you. If you're into pension, you are regulated by a particular, a body and all of that. So you have to follow your sectoral regulation as well. Then listing rules. If you want to trade your shares on the floor of stock market in the Nigerian exchange, you have some rules that you have to also comply with. So those are the four sources. Um we have accounting standard, we have company law, we have sectoral regulations, we have the listing rules for listed companies. So what are the principles and rules? Let's look at principles and rules. So company law consists of detailed rules. Accounting standard may be rule based or principle based. IAS and IFRS are principle based, though some would argue that in practice they are a mixture of rules and principles. It is possible for rules and principles to complement each other. Many countries, including Nigeria, the UK, Canada, and Australia, have a regulatory system in which company law deals only with a few specific matters. Detailed financial reporting practices developed by accounting profession through the accounting standard. So accounting standards are generally principle based, not always though. So this allows reporting practice to develop over time in response to the need of the users and changes in the business environment. Accounting standards usually allow preparers to exercise judgment in developing accounting policies that are appropriate to the circumstances of a particular entity. So this is just, there is always an argument that accounting standards are rule based, but this is just telling us that not all accounting standards are rule based. Yes, there are rules. There's measurement recognition and what's the other one? Or principles that guide, you know, carrying out your accounting transaction. However, you still have to use them in a way that it responds to the needs of the users. You are not, because this says that you should use this, it might not be all applicable to your industry, it might not be all useful for your industry. So you kind of, use your judgments in some particular policies, your accounting policies. Now you cannot say because this is what IS8 says, and it's kind of not reporting, not giving a true and fair view of, or it's not giving the correct position for your financial reporting, and because of that's what IS8 says, you just want to follow it through to the end. Yes, you follow it, but you still need judgment, you still need to, you know prepare your accounts in such a way that the users of the financial statement are able to make decisions, the right decisions from whatever you have prepared. So we have also the conceptual framework. We've talked about the regulatory framework. So whenever you hear regulatory framework, think of laws. And what are the laws? We have the accounting standard, we have the what are they again? We have the accounting standard, we have company law, we have sectorial regulation, then we have the listing rules. Now, for the conceptual framework is a statement of generally accepted theoretical principles that form the frame of reference for financial reporting. So when we talk about conceptual framework, we're looking at what are the principles, what are the generally accepted principles. I think some people call it gap. So what are the generally accepted accounting principles that guides the preparation of financial statements? So in theoretical principles, these theoretical principles provide the basis for development of accounting standard and the understanding of interpretation of accounting standard. And therefore, a conceptual framework will form the theoretical basis for determining which events should be accounted for, how they should be measured, and how they should be communicated to the users of what financial statement. So let's go to the advantages of conceptual framework. So what are the advantages? Why do we have generally accepted accounting principles? So number one, accounting standards are developed on same theoretical principles. So one of the usefulness of conceptual framework, or one of the advantages, that is used to set standard. So it leads to standardized accounting practices, such that the treatment of this item should be consistent. We have, for example, have consistency principles. So what is just saying that whenever you are picking one standard or you are following one standard, you have to follow it to the ladder. You have to follow it year by year, period by period. So it gives like a standardized accounting practice. That's one of the usefulness or advantage of conceptual framework. Another advantage is that it is less subject to political pressure. You know, there could be pressure on people that are setting standards to follow a particular approach, and it will only prevail if it is acceptable under the conceptual framework. So before you can set any standard, or before IFRS or IASB can come up with any standard today, they need to check the consistency. You cannot just say, okay, because the users of financial statement, or the people that they've given their drafts to check, the public that have been given the opportunity to review the draft IAS or the draft standard, they've checked, and a lot of them has voted that this particular there should be this type of standard. They need to check that it's consistent with what this conceptual framework first. Then another one is that it uses a consistent accounting standard use a consistent approach. Without a conceptual framework, some standard may concentrate on profit or loss, while some will concentrate on the valuation of net assets. So they are saying that because there is conceptual framework, there's already a laid down process of which standards should be adopted or should be developed. So a principle based approach avoids the need of for large volumes of rules to address every scenario. Instead, the same underlying principles can be applied to. Yeah, so this conceptual framework is not also rule based, it's more of principle based, such that it helps you, it just give like a guidance. It's not telling you that you have to do this like this. It will give you consistency. For example, consistency rule, you have to, if you pick this rule today, make sure you are using it over and over again. So it does not kind of forces, it does not force any rule on you. It is mostly principle based. Then disadvantage is that financial statements are intended for a variety of users, and it is not certain that a single conceptual framework can be devised to suit all users. So that one is very clear. We cannot use one conceptual framework, or there's already a laid down way. It might not be satisfactory to all the users of financial statements. Then another one is that given the diversity of user requirements, there may be need for a variety of accounting standards, each produced for a different purpose. So there might be bias. So because everybody needs are different. So there might be kind of more focused on the purpose of the financial statement for some set of users than for the remaining ones. So it is not clear that a conceptual framework makes the task of preparing and implementing standard easier than without a framework. Like they're just saying that there's no really justification for having a conceptual framework. Whether there's a conceptual framework or there's no conceptual framework, it does not make the work of preparing standard easy. So we have the IASB conceptual framework. And what is the purpose? The purpose IFRS standards are based on conceptual framework for financial reporting that address the concept of underlying the information presented in the general purpose financial statement. So, what is the purpose of conceptual framework? Number one, it assists the IASB to develop IFRS that are based on consistent concepts. So, with the use of or with the help of conceptual framework, they are able to better develop IFRSs or IASs that are, consistent based on the concept given by the conceptual framework. Then it assists the preparers of accounts to develop accounting policies in case where there is no IFRS applicable to a particular transaction. So there will be times that you come across some transaction and there's no really one particular standard that relates to it. But because you have conceptual framework, you have the going concern concept, you have the accrual concept, you have the consistency concept, you already know how to treat a particular transaction and all of that. So assist all parties to understand and interpret IFRS. That's very straightforward. So what is the status? The conceptual framework is not an IFRS standard. It does not override any IFRS standard, but instead it forms the conceptual basis for the development and application of IFRS standard. So it does not, the fact that they coexist sort of. So it is based, IFRS is based on conceptual framework. It does not replace it. You cannot say now because there is going concern concepts, you will not follow um any of the principles in any of the standards that you have. You still need to look at that one. Is just sort of guiding how standard are set, how standard are issued, so it does not override their existence. So content, the conceptual framework is divided into 8 chapters, and you don't need to know all the content of conceptual framework for this exam. In the rest of this chapter, we'll cover the key part of the conceptual framework that are included in financial reporting syllabus. So the objective of general purpose financial reporting. The objective of GPFR is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. The reason why we prepare financial reporting or prepare general purpose financial reporting is so that the users of the financial information are able to make decisions before giving us their resources. People that are stakeholders, they are able to make decisions based on what we have prepared. So existing and potential investors, lenders, and other creditors are referred to as the primary users of what financial statement. So primary users make may make decision about buying, selling, or holding shares or debt instruments, or providing or settling loans. To make decisions, primary users need information about the economic resources of the entity, claims against the entity, and changes in the resources and claims. They need to also have information about management stewardship, how effectively and how efficiently the entity's management and board have discharged their responsibility to use the economic resources. So they need this two information. When you talk about the economic resources of the entity, you're talking about what their assets look like. If you're talking about claims against the entity, you're talking about their liabilities. You're talking about changes, can be looking at their changes in equity, changes in equity. You can be looking at their cash flow, can be looking at what their profit or loss looks like. The management stewardship, how was the management of the company able to you know manage the resources of the company to the point of having those reports that we have in the A section. So now they started explaining the types of the basis for preparing financial GPFR, general purpose financial reporting. So one, we have the accrual accounting. We are very familiar with this. I'm sure you'd have been hearing this from the very first exam. Accrual, cash base, accrual base. So the conceptual framework requires financial statements to be prepared using the accrual accounting. That is, the effect of transaction and events are reported in the period that they occur rather than when cash is paid or received. So the accrual concept just follows the matching concept. The accrual accounting rather, it follows the matching concept. And what is it saying? It's saying that transactions should be recorded when, you know, when they actually happen, when the effects happen, when it impacted us, and not when we pay for it. You can provide service for me right now in December, maybe December last year. I should now pay in June. That does not mean that the service occurred in June. What accrual concept is, or accrual accounting is saying, that you should make sure that you have booked for the service in December and you are not just booking for it in June. So it's just to ensure that whatever you are reporting, the cost is matching with your costs and your revenue, they are matched against each other in the same period. So that's the purpose of the accrual accounting. Then for the cash accounting or the cash basis, this is a method that, this one is mostly used in government sector. And what do they do? Under this method, your revenue, your expenses are only recorded, or your transactions are only recorded when you receive cash, not when they are earned or incurred. So this method is simple and commonly used by most small businesses, as it focuses on actual cash flow. However, it does not provide a picture of financial performance, since it ignores account receivable and payable. So this is not the best of the method, but some people still use it because they just feel like they just want to know what is the cash position of my business right now. They just want to have like, what's the cash flow position like. They are not really concerned with when it happened or when it occurred. To them, when it occurred is when the money went out. But that's not the best method, because you are not matching, the revenue for that period with the expense for that period. You can be matching the revenue of period A with that of expense of period Z. So it's always advisable to follow the accrual method. So the cash basis of accounting does not fully comply with the accrual basis of accounting, which is recommended by standard setting board like IFRS and GAAP. So the conceptual framework emphasizes faithful representation and relevance, which the cash basis does not fully achieve, because it does not recognize financial events when they occur, but only when cash transaction takes place. This can lead to misstatement of an entity financial position and performance, as it does not account for outstanding receivable. Yes, it won't show you if you are owing anybody, because you are only recording transaction when you pay. It won't show you if anybody is owing you. It won't show you any accrued expenses. Yes, you know that um somebody has rendered service for you in the previous month, but because you have not collected the invoice, you are not recording it, whereas you're supposed to accrue for that expense. So it is very important that wherever you find yourself and they are using cash basis, and you know that the business is quite large. I found myself in that kind of situation before. They were even mixing both cash basis and accrual basis together, and I'm like, you can't do like this. You have to stay on one accounting method. You can't be in between. You have to choose one and follow to ladder. And for their size of business, they should not even be using cash basis, because it's a very big organization. Why are you guys using cash basis? So accrual basis is like, is the acceptable basis if your business is not a small business, or you are not in the government sector. So cash basis is simple and useful for small businesses. It lacks completeness and comparability that the conceptual framework promotes for high quality financial reporting. So now, what is the underlying assumption? The underlying assumption of going concern. Financial statements are normally prepared on the assumption that entity is a going concern that will continue in operation for the foreseeable future. This means that it is assumed that entity has neither the intention nor the need to liquidate or curtail materially the scale of its operation. So whenever we are preparing financial statements, we are preparing with the assumption that this business is not going to crash next year. It is going to continue. This business is not going to crash anytime in the next 12 months. I think that's always the assumption. It's not going to crash in the next 12 months. It's going to continue into the foreseeable future. But whenever you see any sign, there are different indicators of going concern. Probably there is a cash flow problem. You are unable to pay your suppliers on time. key management staff have left you, your major supplier is no longer with you have started losing customers. Those are indicators of going concern, that there's a threat to your going concern. So if you are started seeing all of that, as the financial accountant, you are supposed to prepare your financial statement on a breakup basis. So you're supposed to prepare, you are not supposed to use the going concern basis again, because now you are starting seeing indicators that, okay, oh, you are going to have issue, or this business is not going to continue as a going concern again. So you are going to do what? You are going to reclassify your assets. You are going to revalue your, sorry, you are going to revalue your assets. You are going to reclassify your liabilities. You are going to start checking, each item in the financial statement to see their true value, because if a company is facing going concern issue, it means that it can wind up at any time. You start seeing debtors asking for their money and all of that. So you just need to revalue everything that you have. Breakup basis means that there's an intention to liquidate. It's going to cease trading. There's nobody coming to save the organization, so to say. So you have to, you see them start selling their assets. Debtors are asking, those people that have covenants with debtors, you start seeing them, they've placed lien on some of your assets and they've started taking them. So you need to reclassify, you have to reevaluate, revalue your asset. So what are the qualitative characteristics of a useful financial information? I think there are just two. We have the fundamental qualitative, we have there are two two characteristics. We have the fundamental qualitative characteristics and the enhancing qualitative characteristics. So there are two fundamental qualitative characteristics, which is what? Relevance and faithful, relevance and what? Faithful presentation. And um relevance and faithful presentation, and information is useful if it is relevant and faithfully represent what it purports to represent. Then for the enhancing qualitative characteristics, they are CUVT. Okay, they are just four. Then they are comparability, verifiability, timeliness, and understandability. Okay. I thought they were not going to explain because, okay. So for comparability, it's very clear that any financial information you are giving us must be comparable. So the qualitative characteristics that enables user to identify and understand similarity in difference and differences among items. For example, consider the disclosure of accounting policies. Users may be able to distinguish between different accounting policies in order to be able to compare similar items in the accounts of different entities. So, if you are preparing a financial statement for me, and you have used some set of accounting policies, I should be able to grab your financial statement and compare with that of another entity to see your performance or to make decision. So when an entity changes an accounting policy, the change is to be applied retrospectively. So they advise you to go back to adjust whatever you have done previously if you are introducing a new or you are changing your accounting policy. This is so that by the time you want to prepare another one, maybe for the period, you are able to compare. But let's say you were using a previous accounting policy and you just change it this period, there's nothing to compare it with. So that's the feature of what comparability. So comparability is not the same as uniformity. Accounting policies should be changed if the change will result to information that is reliable and more relevant, or the change is required by what? By an IFRS. So I think that will be addressed under IS 8. So we have verifiability. Verifiability helps us to assure that user it helps users to assure that information faithfully represent the economic phenomena it purports to represent. That is, I can verify it from an independent source. I don't have to always reach out to you to verify something. If I get your financial statement, if I give it to somebody else or an independent verifier, or let's say I want to value your asset, for example, and I call a surveyor or a valuation expert, they should be able to give me maybe the same figure you have for your assets or close to. It's not that by the time I give it to somebody else now, there's a wide difference between what you have said you are presenting and what the person is also giving me. So your financial statement must be what? Must be verifiable. It must be verifiable. From If I give an independent observer, they should be able to agree with the same thing that you have. They should be able to arrive at the same conclusion. So timeliness, you know, as people used to, some organization will tell you, late submission is no submission. If you are preparing, giving us financial statement, you should be able to give us in a timely manner. Then it should be available for me when I want to use it. You should not be giving me information when the time that I need it has already passed. So having information available to decision makers in time, so that they can be able to what? Make their decision. So because old information is less useful. So there should be a balance between the timeliness and provision of what? Reliable information. So understandability. What does this mean? It means that your information must be clear and it must be concise. You must make it understandable, so that people that have at least a reasonable knowledge of the business, they can just look at it and be able to what? Make information. You should not prepare information in such a way that it's only you that understand it. I don't know how to put it right now, but when you prepare, if you are not there, nobody can read it. You have to prepare your general financial report in such a way that is consistent with any standard and all of that, and anybody that has the accounting knowledge, anybody that is expert in the field, not expert, but anybody that has basic knowledge or reasonable knowledge, are able to go through what you have prepared and review it and make decision. So what are the elements of financial statements? We have five elements. This is an interview question for some people. When they ask them that, what are the components of financial statements and what are the elements of financial, they mix it up. So elements are, the way your financial statements are grouped, like is what are the groupings in your financial statement, or the classification you will meet in your financial statement. Why components are what are the financial statements you are preparing itself. So for the elements, we have five. We have assets, liability, equity, income, and expenses. So there's a way IS1 defines assets, and at this level, I don't think they will even ask you what is an asset. But if you come across it, probably the person just want to give you a bonus question. You can't just say asset is what is owned by the organization. Asset is any present economic resource. You need to define according to the way it has been defined here. So it's a present economic resource controlled by the entity as a result of past events. So the reason why most people fail is that they will come and say their own in their own word now. And there are some things that are already, laid down by regulatory framework, conceptual framework. If you are defining assets, for example, I'm not expecting you to use your own words. I'm expecting you to know it according to the standard. Define the asset according to your standard. You are not coming here to come and tell us that asset is anything. No, what's that? It's not anything. Asset is not anything. Asset is a present economic resources that is controlled. So they did not use the word owned by the entity. I can have something now that is not even my own and it's still an asset to me, in as much as it meets this criteria. One, it's giving me what? Cash flow. There's return on investment. um it's also is There's also the exchange of goods, such as trading, selling goods, and provision of service, and there's reduction or avoidance of liability. So assets can be not just, it might not just be anything that you own as an entity. It could be something that is borrowed, for example, or that is leased. It might not just be what you have bought or what you own as an entity. So liability too is a present obligation of the entity to transfer an economic resource in as a result of past events. So an essential characteristic of liability is that the entity has an obligation, and an obligation is a duty or responsibility that the entity has no practical ability to avoid. You have to pay it. That is what liability is. So equity is the residual interest in the asset of an entity after deducting all its liabilities. So equity is what? your net asset. Equity is your share capital plus reserve. Equity is your asset minus liability. So income now, income in assets or income is increase in assets or decrease in liability. If your assets increase, is an income. If your liability decrease, is also an income. So it results in what? Increase in equity other than those relating to contribution from equity participants. So when I say income, I'm not talking about the fact that some people bought more shares or there's an increase in the value of our share or in the value of the shares that are bought by the people that are already existing. So we're talking about if there's an increase in your assets, we're talking about if there's a decrease in your liability. So we have expense. Expense is decrease in assets or increase in liability that result to what? Decrease in equity other than those related to distribution of equity participants. So this definition has to be defined according to conceptual framework. You can see that they are even quoting it like Bible or Quran. They are quoting it, they are giving you, where they got those definition from. So you will not come to the exam hall and come and define it for them in your own words and still expect to get the same mark that they have allocated for the question. You have to define according to conceptual framework. So IFRS Foundation and the IASB. So I think this is just like the story of how they started developing all these our standards that we have today. So the IASC, which is the International Accounting Standard Committee, it was established in 1973 to develop international accounting standards with the aim of harmonizing accounting procedures throughout the world. The first IAS were issued in 1975, and they also have another body called the Standing Interpretation Committee, which is what we know as IASC today. Yeah, is it IASC now? Yeah, International Accounting Standard Interpretation Body also. So um sorry, just a minute. That's what we call IFRC now. So that's IFRS IC, International Financial Reporting Standard Interpretation Committee. So they used to be known as SIC, which is the Standard Interpretation Committee before now. So in 2001, a new standard setting structure was developed, headed by the IASC Foundation, which is now called the IFRS Foundation. So, okay, it's even ESF. So the current structure of the organization responsible for publishing international accounting standard are as follow. We have the IFRS Foundation, we have the IASB, and under the IASB we have IFRS AC, then we have IFRS SIC. IFRS IC. So this is what the structure currently looks like. So the IFRS AC is the International Financial Reporting Advisory Council, while the IFRS IC is the International Financial Reporting Interpretation Committee. So the IFRS Foundation, they are just this these are just history. These are just history. The foundation is a non-for-profit organization that is run by 22 trustees who are responsible for the governance of the foundation and the bodies within it and fundraising. They are also the constitution of the foundation includes I think this is just story bar. So it's just how IASB come to place and what's the composition of the IFRS foundation. So you can just read through. So let's go to the IASB. The IASB is the standard setting body of IFRS foundation, and the IASB is responsible for developing international accounting standard. It has full responsibility for all IASB technical matters, including the issue of IFRS and the revised IAS, and has full discretion over the technical agenda of the IASB. The objective of IASB: one, to develop in the public interest a single set of high quality global accounting standards, to promote the use of rigorous application of those standards, to take account of the special need of SMEs and emerging economies, to promote and facilitate the adoption. It is well o. To take account of the special needs of small and medium-sized entities and emerging economies, and to promote and facilitate the adoption of IFRS through the convergence of national accounting standard and international accounting standard. So the IASB consists of 14 members, all with a very high level of technical expertise in accounting, who are appointed by the trustees of the IFRS Foundation. Each ISB member is appointed for a 5-year term, which might be renewed for a further 5 year term, 5 years. And each ISB member has one vote. So they are just telling you this story because they might also ask you that, what is the standard setting structure, or how did the IASB come to place, and what do they do, and what's their composition. So this is for you to just know, not cram. They have 14 members, and who are they, how are they appointed? Just take note of this paragraph. They have a very high level of technical expertise in accounting. They are appointed by the trustee of IFRS Foundation, and they are appointed for a 5-year term that might be renewed once for a further 5 years. So, and each ISB member has one vote. An approval of 9 members is required for the publication of an exposure draft, a revised IAS, a financial, an IFRS, a final interpretation of the IFRS Interpretation Committee. So now let's look at the IFRS Interpretation Committee. What is their role? What do? They interpret international accounting standard, both IAS and IFRSs. They issue timely guidance on the issues that are not covered by IAS within the concept. So sometimes when you don't understand a particular standard, or there are gray areas, they call it gray areas. So when there are gray areas in a particular standard, these are the guys that are responsible for interpreting whatever is not clear, or whatever people have issue about on a particular standard. And they publish draft interpretation for public comment. After studying responses to the draft interpretation, it will obtain ISB approval for a final interpretation of an IFRIC. So if you're unclear about a particular issue on the standard, they are the one responsible for clearing your doubt. So they also issue this IFRS. So if you have any gray areas that you just want to look into, they are the one you are to reach out to, and everything. Check their guidelines, not reach out to. So IFRS Advisory Council, they provide a forum through which IASB is able to gather opinions and advice from different countries and industry. IFRS AC consists of experts from different countries and different business sectors who offer advice to IASB. So they are the one, as their name implies now, they're responsible for giving advice. They're responsible for gathering opinions from different industry, different country, different business sectors, and they give this advice to the IASB. So IFRS and IAS. So this is another story. So I think I read up that, so we don't use that one to waste our time. So they gave us a list of standards that are testable in this level. So you see, examinable in Nigeria, yes. This level, yes. So I think everything is yes, except, oh, okay, you guys are not doing IS 21. Is that true? Yeah. So these are the standards that we'll be doing in the course of this. They are saying that you're not doing IS 21, but it's inside the syllabus. So I'm wondering. So IS 29 is not relevant. Um IS 34, okay. IS 41. I think I came across IS 41. Okay. Share based payment. No. Okay. No, 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 no. Insurance contract, no. So these are the standards that, so there's a new guy that has joined, which is IFRS S1. IFRS S1. That's sustainability standard. So it has been added to the syllabus. Okay. So if I were you, I'll just list all the standards somewhere and be ticking them as we go, just to be sure that you have covered all the standards. We are not missing out on any of them. So how do they develop a new standard? How is it developed? What's the process like? So the first thing is that they have to identify the standard they want to work on. A subject is identified. Is it a new standard? Do we want to revise an existing standard? That's the first step. Then they go ahead. National accounting rules and practices are now studied, and there's an exchange of views with national standard setters. For example, in Nigeria, we have FRCN. So they'll discuss with them, they will exchange their view. Okay, this is what we want to do. This is the standard we want to review. What do you think? What's your opinion? What's your view? Then after that, they go to the advisory group. That's the what? IFRS AC, to give advice. The advisory group is now, they'll be giving them advice for the standard they want to work on. Then after that, they'll give you what they call discussion document. They'll give it to the public. Oh yeah, everybody, this is the standard that we want to come out with. What, give us your comments. I think it's usually called exposure draft or so. So give us your comments. Let's see. Okay, before they give it out, it's still, I mean, when they give it out at first, it's still a discussion document. Then after they've received the comments, that's when it's now called an exposure draft. So they'll give it to the public for their public comment. Then after receiving the comments on the documents, the ISB will now issue what we call what, exposure draft. And this exposure draft, it includes the opinions of dissenting ISB members and the basis of their conclusion. So all comments on the exposure draft and discussion documents are considered, and it includes the consideration of whether it is desirable to hold a public hearing, whether it is desirable to hold field tests, whether it is necessary to issue a revised ED, exposure draft. Then an approved IFRS is now published. After they have done that, they will now what? They will publish the IFRS that has been approved. So after that, you will now have what, the development of a new accounting standard. Then when they first issue a standard, there's always, you'll be hearing different consultation, different discussion coming up. So if there's any area that they need to interpret as well, the IFRS IC will come in and interpret it. Then the standard is now published and applicable in Nigeria. So that's the process of issuing accounting standard. So accounting standard in Nigeria, this is also another story. How we started from the NASB in 1982. They are responsible for issuing SAS, and it was formed by ICAN. So they were responsible for issuing SAS, Statement of Accounting Standard. So now they say SAS one. I think they have how many of them? I don't even know. So they used to use SAS before we started adopting what we have today, which is IFRS and IAS. So that the story of that at that junction. So we have the FRCN, which is the Financial Reporting Council of Nigeria, and is a federal government parastatal that is under the supervision of the Federal Ministry of Industry, Trade and Investment. So what is their objective? What are they there for? Maybe we already have IFRSB. What are they doing? So one, they protect the interest of investors and other stakeholders. They provide guidance on issues relating to financial reporting and corporate governance to professional, institutional, and regulatory bodies in Nigeria. They ensure good corporate governance practice in the public and private sectors of the Nigeria economy. They ensure accuracy and reliability of financial reports and corporate disclosure. So they are the one responsible for ensuring that whatever you guys are dishing out is accurate, is reliable, and they harmonize the activities of relevant professional and regulatory bodies relating to corporate governance. So you can just pick any five, at least know five of them. What they do, they enhance the credibility of financial reporting, they improve the quality of audit service, accounting service, actuarial evaluation, and corporate governance standard. So what does their directorate looks like? They have seven directorates, and they have been listed: Directorate of Accounting Standard, private sector; Directorate of Accounting Standard, public sector. So, and all of them, they have their what, their responsibilities. So Directorate of Accounting Standard, what are they responsible for? They develop accounting and financial reporting standards to be observed in the preparation of financial statement in the private sector and small and medium scale enterprise, to promote general acceptance of adoption of such standard by preparers and users of financial statements, to promote compliance with the accounting standard developed or reviewed by the directorate, to review from time to time the accounting standard developed in line with the prevalent social, economic, and what, political environment, to promote compliance with the accounting and financial reporting standard adopted by the council, to promote in the public interest accounting and financial reporting standard to be observed in the preparation of financial statements of public interest entities, and to perform such other duties. So people used to say that this is the point where this is like always an additional point for all I can remember. When you have listed, you are exhausted your point and you don't know what to write again, you just add to perform any other duty as might be, and they will mark it for you because it's a point. So, adoption of IFRS in Nigeria. So we have another story. So we have um IFRS cannot be applied in any country without the approval of their national regulators. And who are our national regulators? The FRCN, that's Financial Reporting Council of Nigeria. So they have to approve it, they have to allow it. So all jurisdictions have some kind of formal approval process which is allowed or followed before IFRS can be applied in that jurisdiction. In Nigeria, however, the FRCN has not published any formal procedure of adoption of IFRS, but appears to follow IASB prescription on the new standard, on when a new standard comes into force. So what are the phases? What is the process? So number one, phase one, significant public interest and publicly listed entities. So entities in this category, we have government business, we have entities that have equity or debt instruments that are trading on domestic markets, foreign markets, and over the counter OTC trade. So all other organizations that are required to fulfill. So I just feel like these ones are stories, and they should be, you should just read them up. So let's go to another model. We have advantages and disadvantages of convergence with IFRS. So what are the advantages of everybody adopting IFRS? Number one, we are able to make better comparison. You can compare the performance of this country, of a business in this country, with that of another business in another country. So international comparison is better through the use of IFRS. Another one is it helps to simplify what, the preparation of group accounts. So imagine that you have a multinational, you have a company in Nigeria, you have another one in Ghana, you have another one in Sierra Leone, you have another one in the UK, you have another one all over the world, and they are using different standards. They are not following IFRS. It will be very difficult to consolidate their accounts because they have different principles guiding them. So you will have to be doing adjustment, and some adjustments will actually cost you money. It cost you money, cost you time, and all of that. So, but with the use of IFRS, you are better able to simplify the preparation of your group account. Then another one is that management should, they will find it easy to monitor their performance within the group, because I can just look at group performance at a glance and see if it is performing or not. Then another reason is it helps it easy to have, like it makes it easy to cross border trading. I can access capital abroad because they can understand what I am doing with their money. They have a better understanding of my financial position because of IFRS. Okay, so I think that's the next point, safe. So cross-border trading, you can trade abroad, you can invest money, you can raise finance abroad if you wish to. So what are the disadvantages? It's very strict. So national legal requirement may conflict with IFRS. So some companies now, some countries, maybe not Nigeria, because I've not heard of FRCN saying that we should not adopt any IFRS. But if you're a multinational group or multinational company, you might have some entity in some country, and they'll be like, you cannot adopt because of their national standard setting board. Then cultural differences, it means that you cannot just release one set of accounting standard and expect that it will be flexible enough to meet the needs of everybody worldwide. It's not possible. Then some countries believe that their framework is satisfactory or even superior to IFRS. So this is also a cultural problem, because they believe that, why do you want to impose IFRS on us? I think we are doing well enough. For example, the US, up to now, they have not adopted IFRS. So they have their own US gap that they follow. So that's another disadvantage. So national standard setters and the IASB. National standard setters produce accounting standard for application in their own jurisdiction. However, the acceptance of the benefit of a global set of accounting standard has caused their role to change in many jurisdictions. So what is their role? One, national standard setters have a key role in the development of standard and their implementation in jurisdiction they serve. And the IASB sees the national standard setters as important partners in producing global accounting standard. So one, their knowledge of local financial reporting and legal requirements experience in setting standard and technical accounting capabilities allow them to make valuable what contributions, invaluable contributions. It means that contributions that are priceless. So one of their role is to contribute to the international accounting standard. Then another thing is that their relationship with key stakeholders, they are better able to represent them in international debates. Imagine that somebody from IFRS is coming to address you. I feel like if a local standard center like IFRS, and they'll believe that, okay, these people are for us, they are not against us. They are able to listen to them better than the way they will listen directly from the international guys. So, legal regulations for accounting in Nigeria, we have the CAMA 2020 as amended. We have their rules too that the company must follow. You have to read up that one. Cannot be reading section 374. So we have their own rules. They have their own rules that you must follow. You can see place and duration of records, directors and duty to prepare annual account, form and content of, they have the way you should prepare your financial statement. So, and which is almost synonymous to what we have. Was synonymous to what we have in in IFRS. Then they also talked about the true and fair view, how to disclose loan to directors and officers. So these are all laws, and we have to read them up ourselves. So director's duty to lay and deliver financial statement, director's report. Also, we have another section which is regulatory framework for non-for-profit organization and sustainability standard board. So just to confirm, I want to check our syllabus to see. Okay, so what are the regulatory framework for public sector, non-for-profit organization, and international accounting standard board? So there are different coming. This section provides the peculiar nature and relevant frameworks for specialized not-for-profit and public sector entities, including IFRS, national standard, and IPSAS, as refers to in the syllabus. There are different ways in which organization may be classified. For example, entities can be classified based on what they operate, whether they operate in the private sector or public sector, on whether they exist as a profit or non-for-profit organization. Most public sector organizations would also be non-for-profit. However, sometimes a government might own for-profit trading entity that, for all practical purpose, is just like a private company. So, for example, this AEDC people, that is I think they bought them from PACN. They bought the PACN business and they converted to AEDC, but I still feel like government has a hand in all of that. So they are known as government business enterprises. So government business enterprises would normally prepare financial statement according to IFRS and will not be considered further. Most private sector organizations will exist to make profit. However, there are many who do not. For example, charities. Another way of putting it is that most profit making entities exist in the private sector, but there are some in the public sector, and most non-profit entities are in the public sector, but there are some in the private sector. So hence we need to look deeper into them. So private sector and public sector organizations. We all know what private sector means now. Private sectors are those companies that are owned by, individuals or private individuals or organizations, and they include limited companies, partnership, and sole traders. Then the public sector is the part of the national economy which is under the control of government. Public sector entities include national government, regional government, and their component entities. So difference between private sector and public sector. Ownership for private sector is owned by what? That's for a limited company. There are other forms of private businesses. So, but for a limited company, is owned by shareholders. For public sector, is owned by the people through the government. Then management, it is managed by the owners or managers appointed by the owners. While public sector is managed by government appointees. What is the objective of private sector is to make profit. What is the objective of public sector is to provide a service. Funding, where do they get money from? They can get money from their shareholders, they can borrow from financial institutions. Then for public sector, they get grants from government. So in total, the public sector comprises a large number of organizations which provide a multiplicity of services. Often, often a single public sector organization might have multiple objectives. So it might not just be to do one thing. So government organization, for example, Ministry of Health, they can disease prevention, disease treatment, health initiative, health education, and so on. So in this text, the term public sector entity will be used to mean a body that exists to provide a service to the public at large. All organizations have to be managed to achieve their objective, and to do this, management need information. The information is gathered and processed by management information system. So the information, I think we talked about management information system yesterday. Then the information is gathered and processed by management information system. Then the accounting system is a very important part of the entity management system. So let's just do it. So for not for profit entities, you know that these ones, they have no transferable ownership interest. They are set up exclusively for social, educational, professional, religious, or charitable purposes for the benefit of its members or for the benefit of the public. So these entities are usually charities, and they operate under, there's a regulatory framework for them as well. So not for profit organization is different from profit making in key aspects. And what are the differences? Number one, non-for-profit organization would seek to operate at a surplus. However, any surplus that they get are not distributed to their owners, unlike the private sector. So they are not distributed to their owners, but they are used to do what? Pursue their goals and objectives. Revenue is earned when an organization supply goods to their customer, but for not for profit, how do they get their money? Through donation, through contribution from members, through the cash that they raise from the public. And The financial statement of a non-for-profit might deal with these issues as follow. Financial statement identify the different types of revenue received from the cost of generating this revenue. So it identifies the different types of revenue received and the cost of generating those revenue. So unlike your so you see exactly, they even give us. So unlike your regular financial statement, you will not see represented by. So they will tell you this is our net asset too, but this is what we are supposed to use it for. This is the cost associated with those revenue. So you see restricted fund. So it's not available to be shared as maybe profit or anything. So financial statement should refer to surplus rather than profits or deficits rather than loss. What are they writing? Financial statement should refer to surplus rather than profit. Okay, so they don't call their own profit we've made profit or we made loss. They call it surplus. They'll call it deficits. So their statements are usually different from the regular, you know, our regular accounting statement. So you see them calling receipt and payments accounts. You see them having income and expenditure accounts. Your income and expenditure account is like your profit and loss account in the private sector. Then they also have statement of financial position. So um that's that for public not for profit making organization. So, restriction on assets held generally arise because they were donated for a specific purpose or the money was raised for a specific purpose. So, the Nigerian Accounting Standard issued SAS 32 on accounting by non-for-profit in 2011. This is not examinable at this level. Note that IASB Foundation is not for profit 50 organization that applies IFRS. Note that the ISB Foundation is a non-for-profit organization that applies IFRS in its financial statements. Okay, so what is the conceptual framework for public sector entities? So public sectors, they are owned by government most times. So and their aim is not to make profit, is to deliver public service. So what is their conceptual framework? What does it look like? So they use IPSAS. So IPSAS is what guides the preparation of their financial reporting. So what are the key terms here? Public entities, we've already defined that before. GPFR, we've mentioned what GPFR is. IPSAS is a set of accounting standards to enhance financial reporting transparency. Just like the way you have IAS, their own is IPSAS. So non-exchange transaction. This is a transaction where one party receives benefit without directly giving approximately equal value. So, for example, you give your tax to get road. So it's not commensurate. How much tax did you pay? You know how much it costs to build a road and all of that. So it's not really approximate to the service that they are offering you. Then accrual basis, we've defined that before. Accountability, is the use of resources, the obligation of the public sector to report on the use of resources, give stewardship. They've been given the power to use our resources on our behalf, so they have to be accountable for it. Then sovereign power is the authority of the government to enforce laws, levy tax, and manage public resources for public good. So nature of public sector entity, they are service oriented. Their mission is not to make profits. Non-exchange transaction, as we have said. Budgetary control, what helps in controlling government activities is the budget, approved budget, so to ensure that they don't spend our money anyhow. So long-term sustainability, government projects are usually for a long period of time. So government the power of government is in its continuity. Government does not end. So then regulatory role, they help to regulate, government helps to regulate market, enforce law, and all of that. So what is the relevance of conceptual framework to public entities? It's good for financial transparency. So just to make sure that okay, there's also a standard that is regulating these guys to ensure that they promote public trust. It helps them to make better decision through the use of IPSAS. Then it helps to facilitate international comparability. You can compare what you are doing in this jurisdiction with another jurisdiction. So it helps to strengthen public accountability, because now people know that you are following a particular standard, and you are preparing. You are not just preparing based on what you want us to see to look good in the books, but you are following the laid down standard for preparing those books. Then promoting efficient resource management, aiding in assets and and management, liability management, and reducing financial mismanagement. Then ensuring compliance with budgetary provision. Government can assess financial outcomes against what approved budget. So what are the key impacts of adoption of IPSAS in Nigeria? Still the same thing. Better public governance, enhance financial reporting, it will boost investor confidence, then better budget implementation, then strengthens fiscal sustainability. What are the challenges? Capacity building issue. They don't have the expertise to use it. Let's not lie. Are they even using the IPSAS? So are they using the IPSAS? So because most of them are not trained to use all these accounting standard. Resistance to change, bureaucratic hurdles. We say let's just do it like this. We've been doing it like this before. It might not even be approved by their leaders and all of that. Then infrastructure deficiencies. Then they might not have the financial management information system. They may not have the information system to do all of this. Then funding constraints. They might need to invest. They have the problem of investing in training their staff, or even getting the laptops, the IT infrastructure, the system that they need to carry out this IPSAS. So let's go to the next one. International Sustainability Standard Board. This one is a very recent one. So it was issued in November 2021 by the IFRS to develop a global baseline for sustainability disclosure standard. And it was created in response to increasing demand for consistent, reliable, and comparable sustainability reporting, particularly concerning environmental, ESG, social, and governance factors. In 2021, the IFRS Foundation created the ISSB to deliver a comprehensive global baseline of sustainability related disclosure standard. So, international investors called for corporate reporting on climate and other environmental, social, and governance matters, which is high quality, transparent, reliable, and comparable. The first set of standards was issued in 2022 in order to help them to make better decisions. So, what is the need? Why do we need it? There was before now, they used to say that there's voluntary disclosure of source of anything happening in the environment, sustainability stuff. So, but now they want to regulate it, they want to make it consistent so that what company A is reporting is also consistent with what company B is reporting. Then investor demand for ESG. People that are abroad, they are now not even just people abroad, even local investors too. They are also requesting for let there be standard, let there be regulation. So regulatory pressure. Governments and regulatory bodies worldwide are also introducing sustainability disclosure. So why not just set a global one if different governments have started issuing their own? So integration with financial reporting, then corporate accountability. So what is the rules of ISSB? They are responsible for developing the sustainability standard. They are responsible for enhancing comparability and transparency through the standard that they set. They are responsible for aligning the aligning this the sustainability standard with IFRS. So they are also responsible for facilitating decision making for investors. Then they are responsible for supporting regulatory alignment and responsible for promoting corporate sustainability accountability. To just encouraging companies to adopt business practices that support sustainability. So what are the standards that we have? We have just two for now. So we have IFRS S1. This one is General Sustainability Related Disclosure. Provides a comprehensive framework for reporting sustainability related risks and opportunities. Then IFRS S2. This is climate related disclosure. Focus specifically on climate, align with the TCFD recommendations. So this standard aims to what? enhance corporate transparency, investor confidence, and sustainable business globally. So we have laws and regulation behind the preparation of financial statements in Nigeria. I feel like this is repetition. So we have CAMA, we have FRCN, we have SEC, yes, for companies that are publicly listed. We have FIRS, you know what they do now. They collect tax. Um we have FIRS Act and tax laws. We have CBN regulations like the Prudential Guidelines, Nigeria Deposit Insurance Corporation, regulatory oversight, NICOM. We have the Insurance Commission. Those are the ones that guide these people in the insurance industry. Then we have pension, PENCOM. They're the one that regulates companies that are all these assets, ARM pension, all these pension company, Leadway. They are the one in charge of, regulating those pension industry. Then we have NGX, that's Nigerian Exchange Group. So they are also responsible for regulating publicly listed company. So see the rules guiding them and you see their financial reporting rule in this table. So what do they do? CBN, what do? They regulate and supervise bank, ensuring that there is financial stability and compliance with the reporting guidelines. NDIC, what do? They ensure deposit liability and supervise financial reporting of banks. FRCN, the act, what is it used for? They set accounting standard and enforce, compliance. NIC, the Insurance Act, what is it used for? It regulates financial reporting of insurance company. CAMA, what is it used for? Supervision of publicly traded company. Investment and Security Act 2007, what is it used for? It supervises financial reporting in the capital market. Then pension reform, ensure transparency in pension fund management. FIRS, tax compliance and audit. So with that, we have come to the end of this chapter. So the next thing for us now is to look at, let me see if